The CPI inflation number came out at 8.5% year over year here this morning, and initially the stock market actually rallied up over 1% right out of the gate. So things were looking somewhat optimistic. But just like that, they pulled the rug out from under them once again, and the stock market tumbled into the close. We ended up closing lower by about 0.3% there on the S&P 500. Leading us lower were the financials. And remember, we're on the eve of JP Morgan and other big banks about ready to kick off earnings season for us. So not a great look there. So we'll take a look at that chart here in tonight's presentation. We'll also look at some commodities that are starting to perk up here recently, despite the strength in the US dollar, which is a little bit of an oddity throughout history. And then in tonight's trade application example, as has often been the case, I'm going to show you that it is possible to make money on bullish trades in a bearish market environment as long as you're selecting kind of safer types of setups like sold put trades. So I'm going to review a number of our sold put trades we've done in the past, show you how we're doing with them in real time, and then present a new sold put trade for you on one of my favorite growth stocks that's transitioning kind of from a growth to a dividend growth company in the consumer discretionary space. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 12th, 2022. First of all, for those of you that are new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area and make sure you're signed up for our email distribution list so that way you can be notified anytime we post these videos, and you'll also get the oversold and overbought cluster signals within the S&P 500 at the bottom of those emails. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And it was kind of an awful day, to be honest. The end result was not nearly as devastating as what we've seen in some of the sessions in recent months, but it was the way that we got to the end that was particularly disappointing because while we had a fairly high inflation number here this morning, CPI rose 8.5% year over year, one of the highest readings in decades. The market actually responded pretty well to that initially. S&P 500 was up over 1% at one point in the morning. But as we started drifting towards the afternoon, then all of a sudden the worries started setting in once again. And we did see an onslaught of selling across many different sectors. As you can see from our heat map here, there weren't a whole lot of places to hide when it was all said and done. One cluster of greens that I do see is here in the oil area. How many times have we talked about that? If there has been one consistent and persistent outperforming sector in the year 2022, without a doubt, without hesitation, it has been the energy sector. So once again, they proved their worth here today with Exxon and Chevron and Conoco and others up pretty nicely on a day when most other areas of the market struggled. There were a couple of other areas that did kind of stand out to me. We did see those military defense contracting companies do pretty well here today. Lockheed Martin, Raytheon, Boeing, Northrop Grumman, General Dynamics, and L3 Harris. Those are all part of the big military defense area. Obviously, Boeing has a smidgen of commercial aviation, as does General Dynamics, but they also have military aspects of it, and it makes sense with the war raging on there with Russia-Ukraine. Unfortunately, there is a need for those types of products and services, so you did see that the investing community seemed to do pretty well with those companies here today. There were a smattering of healthcare companies that were up today. I do see Cardinal Health standing out with a very bright green color there. It was up 3% today as a dividend aristocrat. We actually covered Cardinal Health just yesterday in our top-down trend trading class. So while we've owned it a number of times over the years that I've taught the dividend classes, it's fairly rare for us to also look at some of these companies in the trend trading class, but a lot of those healthcare stocks have been perking up pretty nicely lately, and so keep your eye on some of those trends. Some of the bigger players within healthcare did struggle a little bit more today, but there was that nice patch there of green kind of in the middle there. We did have a number of utilities closing higher today as well. I see Duke Energy, I see Southern Company, I see American Electric Power, I see Edison International, I see Sempra Energy, Consolidated Edison. All of those finished in the green here today, so perhaps a bit of a safe haven. Remember, utilities, like energy stocks, have really been strong here recently. In fact, I had a bit of a conversation in my dividend growth investing class earlier today about the utilities and how we've had an over-allocation towards the utilities in my DGI classes since the lows of the coronavirus, because up until the last month or two, utilities had been underperforming. And remember, in a dividend growth investing sense where we're looking towards the long term, we actually want to focus on stocks that are out of favor, therefore their dividend yields are higher. And so we actually had about a year and a half there where we were buying a lot more utilities than what we had in previous years in that dividend class, and now that has been a benefit now that we're watching that particular area start to outperform. How long it lasts is anybody's guess. Keep in mind that utilities traditionally don't do so well when interest rates are rising as they are right now, but today was one of those days where interest rates did give some back, so perhaps that kind of helped them along. But I think right now in general, just because of a more chaotic market environment generally, the utilities are still sought after by the investment community due to their defensive characteristics. You'll also see that off on the left-hand side here, you do have one big rectangle in the form of Apple that managed to close higher today by over 1%. I was actually tweeting about Apple a little bit earlier today as I was tweeting out some information about some of the expectations from the analyst community as to Apple's expected dividend growth that they are supposed to be announcing here within the next week or two. And by the way, earlier today, after the closing bell, we did have Procter Gamble come out with their dividend increase. And remember, they've been doing it for over 60 years, so pretty impressive there for Procter Gamble. It was a 5% increase out of them this year. But remember, you kind of have to set your expectations accordingly after you've built dividend growth for 6 decades plus, as they have. Whereas Apple, you expect a little bit more juice out of their dividend increase announcement with stronger margins and being a more recent newbie to the world of paying dividends. So wouldn't be surprised at all if we get about a 10% dividend increase out of Apple within the next couple of weeks there. So it's good to see them at least holding up, because a lot of the other bigger squares that represent the bigger market cap companies like Microsoft and Alphabet and Nvidia and Meta and Amazon, they all struggled here today. Tesla, you could throw into the camp with Apple. They were, one of the rare mega cap companies that did close the day higher. I saw Kathy Wood being interviewed on CNBC today. Of course, she's been in the hot seat here in the last half of a year or so with her funds really struggling, but she made her name on Tesla, and that's one stock of hers that does continue to hold up pretty well, all things considered. Of course, Elon Musk very much being in the news here over the past week with, first of all, establishing a large stake in Twitter, and then immediately the day after being added to the board of directors for Twitter, or at least that was the assumption. And then over the weekend, it was stated that he has now rejected that board seat and now will remain a standalone investor in the business. So, of course, he's still got his hands full with the whole idea of selling electric vehicles, or at least that's what Tesla shareholders are hoping, despite his ambitions there with Twitter as an investor. So Tesla managed to hang in there pretty well. They do have $1 trillion market cap right now. Sometimes people forget that. Tesla is one of the biggest companies on planet Earth, and so even a 1% move like they had today was impactful, as was the case there with Tesla, nearing its $3 trillion market cap. Now keep in mind, one of the areas that really struggled here today was dead center in the middle there. take a look at all that red in the financials. Not a great look, especially considering earnings season kicks off this week. And earnings season traditionally means the banks are first out of the gate. Remember, in the old days, it used to be Alcoa was the first one that kind of kicked off the earnings party. But then Alcoa kind of went through some reorganization, some spin-offs, and just quite frankly became less important with smaller market caps as the years went on. So they kind of passed the torch here in the last 5 years or so to the banks being the ones that kick off earnings season. And so as soon as tomorrow morning, JP Morgan will be out of the gate, and of course you'll have Wells Fargo and Bank of America and Goldman Sachs and others shortly thereafter. So the world is waiting with anticipation to see how the banks have been handling the most recent environment, because remember, this quarterly earnings season will include the time period from January through March. And of course, we were already struggling from a stock market perspective during that time period, even if there weren't so many disastrous effects on the economy quite yet. But near the tail end of the earnings period, we did have the Russia-Ukraine situation kind of pop up. And so it'll be interesting to hear from executives this time around as to their thoughts not only on Russia-Ukraine, but what it means for higher commodities prices, higher inflation expectations, what their thoughts are with the Fed raising interest rates for the first time in years. So there's kind of a lot going on right now, and I think it's going to be one of those times where you've got kind of heightened interest in what executives are seeing out there in corporate America. So looking forward to that as soon as tomorrow. But for today, once again, the financials looked pretty bad. And remember, that's something I've been sharing with you in the last couple of weeks, so it's not something that just showed up on our doorstep right now. The financials have really been out of favor for the last 2 or 3 weeks, starting with that one day, I think it might have been March 31st, where the financials closed in the lower half of their range on the day when all of the other sectors, pretty much all of the others, healthcare might not have, but most of the other sectors basically closed at their highs that day. And it just stood out like a sore thumb to me that day. So I wanted to share that with you during this very video. And ever since that day, the financials have been an absolute house of pain. They've basically gone straight down. So it's been ugly there in some of those areas. In fact, some of them have become ripe for put selling opportunities. Remember, we actually have a sold put on JP Morgan in this particular market outlook video right now. I think our sold strike is 100. So with it trading at 131, we don't have a whole lot of fear here, but who knows? Maybe with a really terrible earnings announcement, maybe it gets down there. It's hard to say, but what we do know is that we'll find out shortly how banks in America are handling this environment. Let's go ahead and mosey along here now to the charting aspect of Thinkorswim. And I've got our 4 grid pulled up here for chart 4B. And this is for those of you that are premium members of Market Scholars following along at home. Remember, we offer 50 plus customized charts out there for all of our premium members to import into their own Thinkorswim platform. So that way you can kind of follow along a little bit better with David and I, not just during these presentations here that are available for free on YouTube, but of course also for our premium classes that we teach you every single day during the week as well. So let's get started here with the S&P 500 up at the top. You'll notice that we were down 0.34%. Again, not the worst outcome on planet Earth. Really, the disappointing aspect of it was the fact that we were up over 1% early in the day. In fact, you'll see that with today's range, the tippy top high of today was actually higher than yesterday's high. So, we had the possibility of setting up for a nice Cahold bounce pattern here. Cahold is simply an acronym that stands for close above the high of the low day. But the market had other things in mind. That would have been a really nice setup right there, happening right at the moving average. But instead, markets rolled over throughout the rest of the day, and we end up having a lower low, right? We actually ended up closing lower today than yesterday's low, and so on and so forth. We've been tracking our way lower for the better part of the last 2 weeks at this point, after having a really nice relief rally kind of in the middle of March. So we've given back a big chunk of that relief rally at this point, and now we find ourselves trading below the 30-day moving average. Notice the 30-day moving average color is yellow here. And in this particular case, that means that the moving average is rising, but price is below it. So we've got kind of conflicting signals there. So it doesn't mean that this thing is just going to completely roll over from this moment, but it is another warning sign, perhaps. You can also see that we continue to have a weekly bearish posture. Notice the background color of the chart is pink, and that is referencing the fact that this green intermediate line, which is kind of our default posture setting line on the market forecast technical indicator. So unless you hear David and I say otherwise, if you just hear us say generically the posture is X, Y, or Z, what we are referencing is the intermediate posture. But you can set your posture using the near-term line as well. So sometimes shorter-term traders might do that. But for our purposes, we kind of use a more intermediate time period for this general free video here on YouTube. So as you can see, this green line, this intermediate line, fell out of the upper reversal zone back here on this day. And we've now had 3 straight sell-off days since we've turned our posture to weekly bearish. Remember, if this green line were to fall below this indicator's 50th percentile, we would then move to strongly bearish posture. And you'll know that when you're watching the video because the background color will change to this dark pink color like we saw back here. And as you can see, during those dark pink times, those are not great times to be looking for bullish setups. Now, at the very end, of course, that's the case. But the question is, do you feel lucky, right? Do you feel like that you're at the end of a move rather than perhaps the beginning? Because somebody who might have been lucky to do a bullish trade right here might have also tried to do a bullish trade back here and gotten completely run over along the way. So naturally, this information changes each and every day when new information is supplied to us, which is why we do these videos as often as we do. So right now, we do have a weekly bearish posture on the S&P 500 for the 3rd or 4th straight day. Same thing can be said for the Dow Jones Industrial Average. You'll notice it was down 0.26% today. So it held in there a little bit better than the S&P 500 with a few more of those blue chip types of companies in there, along with stocks like Chevron, of course, that did well today with the oil stocks. But anyway, one thing that is different about the Dow is that you'll notice we're still above a rising 30-day moving average here. Notice the difference in the moving average color. It's green here for the Dow. It's yellow here for the S&P 500. And so with the Dow, you could kind of get away with saying it's holding up a little bit better than the S&P 500, not just today by being down less than the S&P 500, but in addition to that, you can see that the intermediate reading for the Dow is higher than it is for the S&P 500 at 68 versus 63. Now, both of them have the green lines falling, and since they're falling below the 80th percentile, which makes up the upper reversal zone, we do still have to consider the Dow with having a weekly bearish posture. But of the two, it does seem like the Dow is slightly stronger than the S&P 500. It's not dramatic, but if you're trying to separate these charts, trying to pick better, situations and setups for yourself, then you could get away with saying that the Dow is a slight outperformer versus the S&P 500 at this current moment in time. Down below here, the NASDAQ was the day's worst performer. It was down 0.3%. Again, not a big and aggressive sell-off, but it was more to the point we were up very nicely this morning, and we completely unwound all of those gains and then finished near the lows of the session. Not only that, but you'll see that we do have what's known as a bearish engulfing candle here today on the NASDAQ composite. Today's body fully engulfed yesterday's body. Not a great look there, particularly when it's happening right on the underside of that falling 30-day moving average. So this is kind of interesting because we've just reviewed 3 charts, and we now have the opportunity to show you all 3 colors on the moving average that exists. There are only 3, and those 3 are the yellow that I mentioned before for the S&P 500, the green that I mentioned before for the Dow Jones, and now the red for the NASDAQ composite. Now the red stands for price is below a falling 30-day moving average. So you could get away with saying the NASDAQ is in much rougher shape than the others, not only just by judging the difference in the moving average color, but again, by looking at the intermediate reading that you see right here, which is at 52 and falling, which is quite a bit smaller or a lower number than the 68 and the 63 we saw up above. So the NASDAQ seems to be in worse shape than the S&P 500 and the Dow Jones Industrial Average. For those of you that have been to my top-down trend trading classes recently, that should not be a complete surprise. We've known for quite some time that the NASDAQ has been struggling, at least from a sector perspective, if you remind yourself that the technology, communications, discretionary sectors are where the NASDAQ finds most of its components. And those are the areas that have been really out of sync with the rest of the market here recently, right? There's been other places to hide out. You've been able to hide out in energy stocks. You've been able to hide out in utility stocks. You've been able to hide out in staples and healthcare, a little bit of REITs. But remember, that's typically not where you're going to find most NASDAQ companies. Every so often, there's of course exceptions to the rule, but what drives the NASDAQ is a little bit of a growthier type of a feel than what you find in with a lot of these other indices. And so not a huge surprise to know that the NASDAQ is underperforming a kind of a broader based, wider variety of sectors that contribute to the Dow and the S&P 500. So we're not quite to the 50th percentile on the NASDAQ, but remember, if we fall again tomorrow, even if we're flat tomorrow, there's a pretty decent chance that as soon as tomorrow, the NASDAQ composite does go to strongly bearish. So be on the lookout for that possibility. Speaking of strongly bearish, we're already there on the Russell 2000. Now, strangely, the Russell 2000 was the only one of these indices that closed higher today. It was up 0.33%. So that's the good news there. The bad news is that was not enough of an effort from the bulls to unwind the strongly bearish posture that was put into place as of yesterday. You'll notice that on yesterday's candle, this background color of the chart went from light pink to dark pink. And the reason for that is this green intermediate line transitioned from being above the 50th percentile to now being below the 50th percentile. And it's currently at 35 and falling. Now, similar to the other indices, this thing was up dramatically earlier today. Look at this candle on the Russell 2000. That long upper shadow suggests that we were way up on the Russell 2000 today. We were just hanging out just on the underside of that 30-day moving average, but we gave up nearly all of that move today. So while the end result does suggest that, hey, there was some bullishness in the Russell 2000, for a lot of people who might have been trading that today, that was probably one of the worst feeling quote-unquote wins that you've had in a long time, because you were winning a heck of a lot more earlier in the session. You'll notice that the Russell 2000 continues to have that red 30-day moving average as well. So similar to the NASDAQ composite, price is trading below a falling moving average, and that's not necessarily a great sign for an index. So, in summary, not a good day. Even if the Russell 2000 closed higher, this was not a good day for the stock market. It was a day where you felt like the bulls had something going early on, and then a big, wet, cold blanket got just thrown on top of everything by the end of the day. So not a robust market environment that we are operating within right now. And again, if you've been with us in 2022, that should not come as a complete surprise. We've been dealing with this chop and slop for quite some time now. Let's go ahead and mosey on over here to the internet. I always like to get a chance to say thank you to those of you that help support this free market forecast or market outlook video, I should say, here that we post on YouTube. And if you get value out of these videos, and if you want to see them continued as often as possible, we ask one simple thing out of you: help support us on social media. In particular, I've got my eyes on Twitter, since that's the area that I tend to hang out in the most. And so if you want to continue to receive these full-length videos, then I simply ask that you click like for me there on Twitter. Remember, there's 4 different ways you can accomplish that task. The last time around you did it for me, it was at 108 likes. So appreciate each and every one of you 108 that did that. But remember, you can find the tweet in question pinned to the top of either my timeline or David's timeline, depending upon who did the video last. You can also find the tweet in question embedded within the description area of the YouTube video for those of you that watch this video directly on YouTube. You can also find the tweet in question embedded on our website under the video for those of you that watch this video on the Market Scholars website. And then you can also find a hyperlinked Twitter icon on the emails that we send you each night. That will also take you to this. So there's 4 different ways that you can arrive at this spot. However you get there, it's the same thing, and we appreciate each and every one of you that clicked like for us. With me being out of town, some of you might have seen my pictures to the Grand Canyon. Late last week, I was not able to do the video on Thursday, as I referenced just a week ago in advance to make sure that you were aware of that. But boy, that was quite the experience for any of you that have ever been to Grand Canyon West. I had been to the South Rim before, but I had never been to Grand Canyon West. It's pretty interesting out there. You go through a Native American reservation and you eventually get to this place, and it's a long drive, but you go through a bunch of really cool Joshua trees and everything like that. But they have a skywalk or a sky bridge out there where you can actually walk out on this kind of U-shaped pathway, and the floor is made out of several panes of glass, so you can literally look down below your feet 2,500 feet below you to the bottom of the Grand Canyon. So I had a lot of fun with my wife and my son doing that. So appreciate you guys giving me an opportunity to step away from the video there on Thursday. But last Tuesday when I did the video, I appreciate each and every one of you 108 that clicked like there for me, which is why I'm doing the full-length video for you here today. So I always like to say thank you to Prickly Trader and Becky and Claire and Michael and Roger and Fred. Nothing. Thanks, nothing. Thanks to Margie and Ron, Claire, Patrick, John, Brian, Tesla Bot, Andres. Good to see you in class the other day, Andres. Stock Market Junkie, Sonia, Kenneth, Ayokipa, Paul, Dale, Tom, Gerald, Kirka, Surendhar, and others. Too many names to go through here, but I see all of your notifications coming in, and I appreciate all of you. So thank you so much for those of you that help us along with that. While we're over here, let's also chat about the Sector Selector. Now, even though I was on vacation last week, because I did have some reasonable internet access in the hotel room I had, and I decided to bring my laptop with me, I was able to get the Sector Selector and the Stock Selector tools updated on Friday evening like I typically would, even if I was back in my home office here. So let's go ahead and take a look at the information here as of Friday night. You can see energy once again was at the top of the graphic. Remember, this has now been ongoing for a full 3 months plus, with energy not budging from the top. So sometimes people get a sensation that, hey, once a sector gets to the top, then we're too late, right? That's sometimes the comments that I'll hear, like, we're up at the top, so I need to look at other sectors that are not up at the top because, I've already missed the move. Well, energy in this case, or in this situation, is case in point that even when you got to the top on energy, you still would have been better off focusing on that area if you were looking for price momentum, price strength, relative strength, right? Because the energy stocks, time and time again, have been proven winners in the year 2022. Eventually that'll change, but we'll hopefully start recognizing that through broken trends and different things like that. But right now, the energy stocks continue to hold up their end of the bargain. And again, one of the few areas that was up here today. As I mentioned earlier, utilities have done pretty well here as well. Utilities stayed at the number 2 position, and really for the last 3 months, they've done pretty well. If you kind of track backwards with this yellow ball here, you'll see that they've been mostly in the top 4 sectors that we have an interest in my top-down trend trading class during that time period. A couple of times along the way, they slipped out of the top 4, but more times than not, they were in the top 4. So while we don't necessarily talk about utilities as much as we've talked about energy from a sector perspective, they've done a good job staying fairly resilient up there towards the upper echelons as well. And then we do have a couple of new things to discuss this week. Consumer staples made their way into the number 3 position. Remember, they had fallen out of favor there towards the end of February, early March time period, right after the Russia-Ukraine news broke. And commodity prices went up substantially. Remember, Ukraine being a big producer of wheat and corn and other things like that, consumer staples companies take that information, those inputs, and then process those grains into a finished product that they then sell in the form of, let's just take Kellogg as selling a box of Special K. Imagine they need a bunch of grains and wheat and other things in there. And so if those prices are going up, there are no guarantees they can pass along those costs to the consumer. And so I think there was some fear in the marketplace there for a few weeks after commodity prices exploded. The question was whether consumer staples could pass along those price increases or not. You can see now that the consumer staples have kind of swung back into favor. Maybe there is some more expectation that indeed will be the case. Or perhaps they're just simply benefiting because of their defensive characteristics, similar to what I'd mentioned before about the utilities. Healthcare is new, right? So whereas consumer staples had been as high as number 2, few of those weeks, 2 or 3 months ago, healthcare had not been in the top 4 in the previous 3 months up until this past week. They finally cracked into the top 4. The highest they had been previous to that were in the 5th place a few weeks here and there. But for the most part, they've been moseying their way up from the bottom of the graphic up towards the top. And I remember that there was a market outlook video here maybe 3 weeks or so ago where I pointed that out to you is at a time when the market was struggling. I said, don't fall asleep on healthcare. All of a sudden, they're starting to make a move. Now, I had an egg on my face for a little bit because I remember after making that statement, the healthcare stocks did fall the next week, but maybe they just needed to get their act together because since that particular week, they have now been rallying nicely. And it's mostly the large cap healthcare companies that are doing that. A lot of the smaller healthcare companies are still struggling, but those large cap pharmaceutical names have been really kicking it into high gear here recently. So that's a little bit of a new situation there that you'll want to keep your eyes on. On the bottom side of the graphic are those areas that I'd mentioned previously that are well known within the NASDAQ composite: communications, technology, discretionary. That's oftentimes where you're going to get some of your best growth stocks. But unfortunately, right now, growth stocks are largely out of favor compared to value and income stocks. So those types of companies are kind of in the penalty box at this moment in time in terms of a relative strength perspective. Like I always try to remind you guys, I myself am a long-term investor. So I actually like to look for opportunities in those beaten up areas of the market. But my time horizon is going to be a lot different than many of you who watch this video, which caters a bit more to the active trader. So if you're looking for relative strength, stick with the stuff up at the top. If you're looking for a long-term investment, then that's where you can start sifting through the rubble on the stuff on the bottom. Let's take a look at the factor selector as well. Since I wasn't with you in the video last Thursday, I didn't get a chance to review that information with you like I normally would have. Now keep in mind, I'll be producing a brand new factor selector first thing tomorrow morning. So this is about a 1 week stale at this point, but can still give us a gist as to what's happening within the market from a slightly different perspective than what we just looked at a second ago with sectors. Factors are a different way to slice and dice the market, and they are not driven by the business model of the companies in question the way that they would be from a sector perspective, right? If you're a utility stock, you're not going to also be a technology stock. Factors are a little bit different and kind of broader in a sense and overlapping in a sense because you could have a stock like Verizon, which is a mega cap company, be part of the low volatility group. It could also be part of the dividend yield group. It could also be part of the value group. And at times it might very well be quality and momentum depending upon circumstances. So it's not quite as clean of a way to slice and dice the market, but nonetheless gives us a sense as to what types of stocks are in favor in the market's eye at any given moment in time. And again, tomorrow morning in my factor-based swing trading class, we'll be reviewing the freshest version of the graphic, but this is 1 week ago, and you can see that there were a couple of new things to report, which is dividend yield fell out of the top spot for the first time in nearly 3 months. You can see this green ball here moving backwards was basically at the number 1 spot from January 25th all the way to March 29th. So that was a good run that dividend yield had as outperformers at the top, but they've recently been supplanted by low volatility. Part of the reason behind that is what I have already mentioned. Remember, if you're to think about what types of company have the slowest movements on the charts and the least erratic movements from a stock price perspective, one of the first areas you're probably thinking about in your mind right now is utilities, the most boring companies on planet Earth in many cases. But right now, utilities are where it's at, right? Boring is beautiful in this market. Utilities are doing well. And so I think there's an element of defensive, boring characteristic types of companies like utilities that's really supporting the low volatility factor at this moment in time. On the downside of the graphic is the low size category. Now remember, a second ago when we were looking at the Russell 2000, remember it was in the strongly bearish posture, and that had happened a day or two ago, right? Today the NASDAQ joined it, but Russell 2000 was already there. Pointing out the Russell 2000 specifically because remember the Russell 2000 tracks the small cap stocks in the United States. In other words, low size companies, and is a pretty good proxy for what's happening with the low size factor. So they had a pretty good run here at the end of February, beginning of March on a relative basis, but they've kind of fallen flat on their face here more recently as some of the large cap companies have received a little bit more interest from potential investors. So low size, in this case, replaced quality there at the bottom. Low volatility replaced dividend yield up at the top. Let's get into some more thinkorswim charts now. Pop back on over here to the platform and do some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid. A reminder that the background colors on these 12 grid charts will tell you what the current posture is, right? Because they're kind of miniaturized the way that they are, it would be a little bit too hard to kind of flip-flop back and forth between the color-changing backgrounds like we do when we're looking at the 4 grid. So when you see these solid background colors, it's telling you what is the current posture right here, right now. And as you can see with this first set of 12 grids, our green charts are on the bottom rung. We've got the US dollar in the lower left-hand corner, we've got gold right next to it, and we've got the 10-year treasury yield off to the right-hand side. The exception to that in the bottom rung is oil. Now, oil was up nicely today. It was up 5%. So there's a pretty decent chance that if oil can continue this surge here in coming days, it can turn around its posture, and it very well might be able to get back to weekly bullish. After all, that's exactly what gold did. Remember, it was a week or two ago we were talking about gold having a bearish posture at that time because it started trading below that moving average, but it's really stabilized and built upon some bullish energy here within the last week or so. So if oil can kind of repeat that process that gold has already proven willing to do for us, I think that there's a very good chance that oil can turn back to a bullish posture here, right? We're in the right environment for it. We're in a high inflationary environment. It doesn't seem like we're going to have peacetime over in Ukraine anytime soon. It seems like commodities are still going to be in demand and supply is going to be limited. And so it feels like the type of market environment where oil could make a decent run. What kind of is on the opposite side of that coin is the fact that the US dollar is strong, right? And a lot of times what you do find is that when the US dollar is strong, commodities are weak, all else being equal. Now, again, we're in one of those market environments right now where not all else is being equal. We are seeing a very dramatic set of circumstances being forced upon the world as a result of Ukraine-Russia situation. So the commodities this time around, normally when you see the dollar this strong, commodities are not going to be this strong. But right now, because of the commodity producing area of the world in a military conflict and thus limiting the supply that normally otherwise would have come from those areas, you're in a little bit of an oddball situation where the US dollar is strong due to its safe haven status, and you're also seeing strength in commodities at the exact same time. So there are other drivers in part of that, conversation as to how something gets priced. So the good news is gold has already shown that ability to get back above it with oil's 5% rise today. You'll notice it's also just barely above its moving average. I know that because not that I can spot it with my naked eye, but what I can see with my naked eye is this green colored moving average. And so that tells me that price just barely closed above that rising moving average. Remember, for those of you that are premium members, on these 12 grid charts, you can right click on them and then go to maximize sell. And then sometimes you can see that a little bit better there. And you can see that just barely here, USO closed above that rising moving average, probably only by a couple of pennies, but nonetheless, it was able to accomplish it. You can also see down below how the market forecast posture is established as well. And that green line seems to have flatlined here in the last couple of days. So that's a good sign because it won't take as much energy to actually push that green line higher compared to if it were in kind of a nosedive green line like we saw back here. Here, even a good up day like we saw right there was not enough to turn around that sharply turning lower green line. But if the green line has now started to flatline, a couple more bullish days for USO should result in a bending higher of that green line there as well. And then that background color of this chart will turn green at that time as well. So let's be on the lookout for that possibility. As I mentioned earlier in the presentation, take a look here that the 10-year Treasury actually sold off a little bit here today. We settled in at 2.72%, which is a rare down day. You can see we had 1, 2, 3, 4, 5, 6, 7 straight up sessions in interest rates. Today was the first one that was a little bit lower, but obviously we are still in an immense uptrend with a strongly bullish posture on yields and interest rates at this moment in time. I do like the way that gold is setting up bounce-wise right there. So for those of you that have some elements of gold in your portfolio, we actually have some GLD in my top-down trend trading class right now. So we are happy to see this bounce right here. There may be some opportunities emerging soon enough in some nice gold mining stocks as well. So keep your eyes on that possibility there. In terms of all the other charts here, it's pretty ugly out there. Let's be honest. There's a lot of dark pink background colors on the charts telling us that we have strongly bearish intermediate postures. And even of the ones that are light pink, in particular EFA and EEM up here, those are not good looks for those charts. In fact, to me, they look worse than the S&P 500. And the reason I say that is notice the moving average color is red on both developed foreign stocks and emerging foreign stocks. Not a great look there because it's giving you the sense that that falling 30-day moving average could very well continue to operate as some sort of a resistance zone moving forward, and that the path of least resistance continues to be to the downside for foreign stocks. Remember, foreign stocks tend to struggle, all else being equal, in a strong US dollar environment, and that is what we are in right now. So that's not really helping their cause at this moment in time. Of course, a lot of you might have seen my retweet here the other night about Charlie Munger apparently getting out of half of his Alibaba shares here recently. Now, what we don't know is why he did that. He might have very well did it for tax purposes or other things that we can't see on the surface, but that was a little bit of a surprise because Charlie Munger is not the type of fella that is known as a trader. He usually buys stock and sits on it for years and years and years. So even he's been maybe a little bit shaken, depending upon circumstances, with some of those Chinese stocks like Alibaba that would be impacting EEM as the emerging foreign stocks in this case. Let's take a look now at our Sector 12 grid. And our Sector 12 grid will be chart 5C for those of you that are premium members following along at home. As mentioned before, it was the energy area that seemed to be our outperformer today. XLE was up 1.66%. You can see that energy stocks do currently have a strongly bullish posture as they are continuing to rise above that rising 30-day moving average as well. So of all of these charts on the board, energy is really the only one that looks this consistent along the way. Again, going back to what I'd mentioned on the Sector Selector. Even if you had looked at it exactly 3 months ago when it was already at the top of the Sector Selector, you would have been better off buying that strength as opposed to assuming that it was about ready to end. And that continues to be the case in this bullish environment for oil stocks. Other areas that were up today include materials just barely getting their head above break even. up by 0.02% today. Same thing for the staples. They were up 0.03% today. Utilities did a little bit better, and they were up 0.38% today. So again, energy and utilities leading the way on the Sector Selector tool. In terms of who the worst performers were here today, that's where, again, I will point out the financials in the penalty box. They were down over 1% today on the eve of JP Morgan reporting earnings. This is that candle, by the way, that I was referencing earlier. And it was actually, I need to correct myself because I said it was March 31st previously because I couldn't remember for sure. Now I can see for sure it was March 29th, the day that I pointed that out to you guys in this very video where I said financials don't look like all the other charts. If you look at the gray vertical lines on all the other charts, it matches up with that same March 29th date. And look at all of them being closed at the highs of their session, pretty much without exception, other than the financials. Healthcare were kind of closing in the middle of their range that day, but most other sectors closed at the highs of their range that day. But I went out of my way to point out that the financials stood out like a sore thumb to me that day because they closed near the bottom of their day on a wildly bullish day for the market in general. In fact, that happened to be the top of the S&P 500 as well. Didn't notice that before, but that was the case. Notice that that day right there that I'm circling on SPY was the same day as I'm pointing at right there on the financials. And look at what has happened to the financials since that day. It has been a bloodbath. You've only had one up day that entire time since March 29th. That is aggressively lower. And so we'll see, perhaps earnings season can turn that around, but from a purely technical perspective, it's not a very good look, and that is why financials do continue to have that strongly bearish intermediate posture with that dark pink background color that we're seeing there as well. Now, in terms of today's trade application example, remember we already did the trade application example. We do those while the market is open, and we let all of you who are premium members know what those trades are in real time by sending you out a Telegram notice whenever we place our trades. So that way you get some extra information before everybody else who's just watching the free YouTube video later that night. But the trade that I did was from the discretionary area. Now remember, discretionary has been out of favor, and going back to what I had mentioned a little bit ago when I said that as a long-term investor, I tend to look at the sectors that are at the bottom of the sector selector for opportunities. Now, if I'm a short-term trader, that's not the case. But as a long-term investor, I'm looking for stocks that have gotten bludgeoned. And we've done a lot of that. Remember, I've actually had a ton of sold put trades during this bearish market environment. And the last I looked, all of them, with the exception of Best Buy, are in profitable territory. So Best Buy, if I'm not mistaken, we are down just barely on. Let me go over here to the trade tab. And yeah, we're down a whopping $3.50 on Best Buy. So let's call it flat. But other than that, all of our other sold put trades are making money. And remember, those are bullish trades. So we are making money on bullish trades in a more bearish market environment because we're not being too aggressive with our bullish trades, and we're doing it in appropriate ways by looking at stocks that had already been beaten up, but also were higher quality companies along the way. So others that I had written down that we still have sold puts on, I had mentioned JP Morgan before. That will likely expire in 2 days. We're up $103 on that one because we sold the $100 put. We're also in Home Depot. Home Depot, that one will expire in 2 days as well. We sold the $250 put. We made about $250 on that sold put thus far. Others that we did, Kellogg shows up, but this one was a little bit of an awkward one, or an oddball one, I should say. Remember, we did this trade a long time ago. This was way back about a year ago or whenever it was, because I wanted to kind of exercise an experiment of selling a leaps contract as opposed to a typical shorter term range. And of course, we've done tremendously well there. Our obligation is at the $50 strike, and we're up $542 on that sold put trade there, as consumer staples have done just fine here recently. Another sold put trade that we're currently in, a recent one, Polaris. I think this is the one I did exactly 1 week ago. We're already up $25 on that. Our obligation is at the $80 $50 strike there in the month of May. What else have we done? We've also done Phillips 66. We sold the May 55 puts. We're already up 47 bucks on that one as well. Of course, energy companies have held up there reasonably well. We also did PayPal, so a rare non-dividend paying company, because I kind of felt like some of those fintech stocks have been beaten up too badly. So we actually sold the $75 April put on PayPal way back in February when the markets were really unwinding, and we've made about 86 bucks on that, and that'll expire here in a couple of days. We also have a put on Whirlpool that we put on more recently. This is a May contract that is the 140 strike, and we're up about 25 bucks on that. Now, again, these aren't huge amounts of profits, but the point that I'm trying to stress is a lot of people feel like it's impossible to make money on bullish trades when the stock market itself has been bearish. And I just showed you through all of those bullish trades that I presented to you for free on YouTube, how many of them are profitable. All of them except for Best Buy. And Best Buy, really, you could get away with just calling flat. So as long as you're concentrating on high quality merchandise and you're going about it in a process that I teach my Options for Long-Term Investors class on Monday afternoons, I think you can still find success doing bullish trades in bearish market environments. Again, going about a process. So let me present the one that I did here today. And this is a controversial company right now. It's Starbucks. Starbucks, of course, has been hit on multiple counts. Not only is it a big China play these days, as China is its second most important market after the United States, Chinese stocks struggling, the economy in China struggling with Shanghai and Shenzhen and Beijing and other major cities still struggling in some degrees with the coronavirus situation. And so without a doubt, Starbucks is having a negative impact from its exposure to China right now. In addition to that, a lot of its US-based stores are going through unionization attempts. And of course, that could end up limiting profits as well. In fact, recently we heard that the CEO of Starbucks stepped aside and Howard Schultz got brought back in. Now remember, Howard was not the founder of Starbucks. A little bit of a trivia item there because so many people assume that he was the founder of Starbucks. That's not actually the case. But if there was one person directly associated with Starbucks over the years, it would have been Howard, because he started with them when it was a basically next to nothing company and converted it into a global powerhouse. But anyway, once Howard stepped back into the spot of the CEO role from a temporary basis here until they find somebody more permanently, one of the first actions he made was to eliminate the stock buyback program. You can imagine how Wall Street reacts to that news. Remember, in a lot of cases, the company itself is the buyer of last resort. And so if the buyer of last resort has disappeared, then all of a sudden there may be more negative downward trading. Now, Starbucks, you'll recall, has had a history with this particular presentation that I've given you over the years. In fact, I can still see some of my old markings right here. Some of you will recall that back in June of 2018, I did a long call trade on Starbucks. In fact, I think it was a leaps trade because it was more of a it was a trade that we ended up rolling a bunch. I can't remember the exact specifics about it, but I can see all of my gray ovals here. We started it back here, and the reason I presented it to you at that time is it had a 3% yield at that time. And it was the first time in Starbucks' history that its dividend yield was 3%. We then rolled it again right here. We then rolled it again right here. We then rolled it again right here. We then rolled it one last time right here. And in all of those rolls, we completely extracted our entire cost basis out of that move. So it ended up being one of the most successful market outlook trade applications that I've ever presented to you guys. Now, of course, I didn't know it for certain at that time, but what I can tell you is at that time, I was fairly confident that Starbucks was a very good selection for somebody that was thinking beyond just the next 2 days or 2 weeks. And part of the reason, as I mentioned before, is because it offered a 3% dividend yield for its first time in history. In fact, we also bought it in my dividend growth investing class that exact same week that I presented the trade here in the Market Outlook video. And we also sold puts on it in my options for long-term investors class. And so we actually had 3 trades all at the same time, all bullish going on Starbucks at that time when it completely fell out of bed and most traders hated it, right? Now, today, we're not in the same mode, so I do want to caution some of the temperance of your enthusiasm knowing that information. By the way, Starbucks eventually rallied strongly and then fell with the rest of the stock market in the coronavirus. It did end up giving you one more time to give yourself a 3% dividend yield right there near the lows of the coronavirus wipeout, but then, of course, rallied to all-time highs very quickly thereafter. Where we stand right now is Starbucks has sold off aggressively. And you can see that we have this little green dot that's showing up under this week's price bar. What that suggests is we have a weekly oversold cluster signal using the market forecast technical indicator. And a lot of times that can tell you that the stock is somewhat nearing a bottom. It doesn't mark the exact bottom. Over here it did, by the way, at least for the next year or so until it fell out of favor right there. But you can see that it also has had some of these green dots showing up lately, and that has not yet marked the bottom. It's in the process, hopefully, of finding a bottom. But unlike back here, Starbucks does not have a 3% yield right now. So I would not be as aggressive with Starbucks right now, which is why I sold a put on Starbucks right now as opposed to buying calls like I did back here. That is a much more leveraged directional bet. By selling puts, you're giving yourself the freedom to be wrong in the short term, but if push comes to shove, giving yourself the opportunity to buy a high quality company at a much lower price. And what I sold here today with Starbucks was the May 27th $65 put. Now, I sold it at the end of the day today, so of course there's not much movement in the P&L right now. We're up a whopping 50 cents, which won't even get you a cup of coffee at Starbucks these days. The reason I selected that one, which is a little bit of an oddball one, many of you know my routine typically is to select the monthly contracts. In this case, I also like to have a 1% return on risk or thereabouts. And I couldn't quite get away with doing the May monthly contracts if I wanted a 1% return on risk. But if I went out one more week, I was able to get approximately a 1% return on risk there. Now, the reason I selected 65 is because of what I had mentioned before. My own personal belief, and I could be way wrong about this, but my own personal belief is if Starbucks shows up on your doorstep with a 3% dividend yield, you should take a serious look at it, right? That's not a recommendation. I can't offer those. Not legally able to do that. But I would just simply state that there's only been 2 times in history that Starbucks has given you an opportunity to have a 3% dividend yield, and both of them have proven to be immense opportunities. So right here, closer to $79, it only has about a 2.5% dividend yield. But as you can kind of see here in this yellow label up at the top, the 3% yield level would be 65.33. You can also see that 65.33 kind of to the left of my cursor that I'm highlighting right there as well. So in other words, if we sold the $65 put and this stock did fall from 79 down to 65, forcing our hand to buy the stock, we would be buying it at that time with a 3% dividend yield. And I do think it would be a great opportunity at that particular level. At this level, I'm not quite as robustly anxious to jump into it. I still think it's a reasonable purchase at this level, but I would be kind of pounding the table, so to speak, if it were to fall down here to 65. So don't be surprised if I bring that up to you at that time, if and when that does happen down the road. Right now, we don't know if that will happen. What we do know is that you can sell a $65 put, putting yourself in position to purchasing the stock at that point if you so desire. Okay, so that's what I had for you here today. Hope you got value out of my presentation. If you did, I ask one simple thing out of you. It only takes 5 seconds out of your time and doesn't cost you a penny. All that is to click like for me there on Twitter. As long as 100 or more of you have done that for me, I'll plan on doing another full-length video for you again on Thursday when I'm scheduled to do this video. And remember, Thursday will be the final trading day of the week because of Good Friday there as well. So again, appreciate you guys checking out the video here, and I will wish you all the best of success with your trades and your investments. Goodbye for now.